Hey everyone, welcome back to my channel. Today, I want to open with a question that many traders are afraid to truly face. Why does your market structure look absolutely perfect? You draw your higher highs and higher lows. Textbook perfect. You spot the CHoCH exactly by the book. You mark out the order block and set a clean limit order to catch the reversal into the new trend. And then, one single candle. Snap. It destroys the entire structure, wipes out your stop loss, and the market keeps moving in the opposite direction. As if your stop loss never even existed. So ask yourself this: if structure keeps getting broken, then what is the market really targeting? In this video, I'm going to show you exactly why. Why a simple break of a higher low doesn't mean a reversal. Why a clean CHoCH is sometimes nothing more than a trap. And whether market structure or a liquidity sweep is the real confirmation you should trust. So if you want to understand how smart money truly moves price, hit like, subscribe, and we'll jump in right after the intro and disclaimer. Alright, let's get into the core idea. What exactly is liquidity, and why do traders call it the fuel of the market? Liquidity is one of the most fundamental concepts in trading. To understand it, think of it this way. For big institutional players to buy massive positions, they need an equally massive number of opposing sell orders to fill their purchase. For them to sell those huge positions, they need a large volume of buy orders to offload their assets. Light bulb, where does this pool of necessary buyers and sellers come from? The primary source of this massive, readily available pool of liquidity is retail traders' stop losses and limit orders. When a large player wants to buy, they look for areas where there are many stop-loss sell orders placed by retail traders below key lows. Executing these stops provides the massive volume they need to enter a huge long position. Big players move the market towards these dense clusters of stop losses, effectively sweeping the liquidity to fill their own orders before reversing the price. But more specifically, how do big traders know where those liquidity pools are likely to form? The answer is, they anticipate them. For example, areas like equal highs or equal lows. Whenever price forms a double top, double bottom, or perfectly equal highs, equal lows, retail traders think, this is a super strong support or resistance. Price will bounce. So they buy at the double bottom, stop loss right below. Sell at the double top, stop loss right above. And just like that, they create a perfect liquidity pool for smart money. So what does smart money do? They push price through those equal highs, equal lows to sweep the stops. This is called a liquidity sweep. Right after the sweep, price often taps into an FVG, hits an order block, or reaches a demand-supply zone, and then reverses exactly in the original direction. But here's where it gets really interesting. You may be wondering, wait, if price breaks the lows, isn't that a change of character? Isn't that supposed to be a reversal signal? Yes, technically that's correct. A CHoCH signals a shift in market character. Price breaks structure against the previous trend. For example, breaking a higher low in an uptrend or a lower high in a downtrend, suggesting a potential reversal. So then why didn't price actually reverse? Why did that CHoCH turn into nothing more than a liquidity sweep? And more importantly, how do we clearly distinguish a real CHoCH from a liquidity grab? And which one is actually more reliable? To answer that, we first need to understand why our CHoCH signal failed in the first place. If you zoom out the chart for a moment, you'll notice something important. This is part of a much larger trend. What you thought was a reversal is actually just a retracement. Price is simply pulling back to retest a key zone and to fill an unfilled FVG sitting below. And beneath that equal low, there are tons of retail traders placing their stop losses, expecting the next leg up. Big players know this, so they intentionally push price a bit lower to clear out those stops. Then enter their positions and drive price back in the direction of the higher timeframe trend. And only above that, that's where the real CHoCH happens. The move below was nothing more than a liquidity sweep, not a true reversal signal. And here's another example that shows you how market structure can fool you. Price is clearly in a downtrend. At this point, price breaks above the trend line. Right here it looks like we have a swing high. Price then breaks above that swing high, and the moment you think this is a change of character, a potential reversal. Unfortunately, price only breaks slightly, grabs liquidity, and then continues to drop aggressively in the direction of the main trend. This is a classic liquidity sweep, where the big players trap late buyers. So, as you can see, even when market structure tells you a reversal has happened, liquidity can sometimes prove the exact opposite. Breaking a lower high usually signals a CHoCH. But if there's a strong demand zone or an unfilled FVG sitting right above, that break is nothing more than a liquidity grab. So, how do you tell what's real and what's fake? Fake CHoCH. A fake change of character happens when the market looks like it's reversing, but it's actually just grabbing liquidity. First, there's liquidity resting just beyond a key structural point. This is where a large cluster of stop-loss orders tends to sit, especially around equal highs or equal lows. Price will briefly push beyond that level, just enough to collect those stops, then quickly snap back in the direction of the original trend. It looks like a reversal, but in reality, it's nothing more than a liquidity sweep. Second, there's an unfilled FVG or imbalance. If price left behind a fair value gap, it almost always comes back to fill it. So when you see a CHoCH forming before the FVG is filled, it's usually just price retracing to fill that gap, not a real trend change. Third, the higher timeframe trend is still strong. If the higher timeframe is clearly trending, with a clear sequence of higher highs and higher lows, or lower lows and lower highs, then small changes of character on the lower timeframe are usually meaningless. They're simply minor pullbacks within a dominant, higher timeframe trend. Real CHoCH. A real change of character signals an actual shift in market direction. First, there's no significant liquidity left. A real CHoCH usually happens after liquidity has been taken. Ideally, the major liquidity levels from the previous trend have already been swept, and there's no obvious liquidity left for price to continue in the current direction. That's why price reverses. Second, strong zones have already been tapped or invalidated. Key OBs, FVGs, supply-demand zones, they've all been hit or broken. There's no more fuel to keep the old trend alive. Third, the main trend is losing momentum. You'll see new highs, lows failing to form, candles losing size, wicks getting longer, volume drying up. The trend is running out of strength. So when a CHoCH forms, it's more likely genuine. Fourth, price doesn't bounce, it breaks with conviction. A real CHoCH doesn't just poke through a level, it runs through it. You get a clean break, solid candle closes, and continuation in the new direction. That's a real shift, not a trap. So, which one is more reliable? The CHoCH or the liquidity sweep? In reality, these two signals are meant to work together. A CHoCH is a change of character in the market. It happens when price breaks structure in the opposite direction of the previous trend. But it only becomes meaningful after liquidity has been taken. That's when it actually indicates a potential real reversal. I hope this video helped you understand how smart money uses liquidity to shape market structure, and why mastering both concepts can completely level up your trading. If you found value in this, make sure to like, subscribe, and turn on the notification bell so you don't miss the advanced breakdowns coming next. Thanks so much for watching until the end. I'll see you in the next video.